This topic examines the investment setting and the actions of the rational investor in seeking additional returns for taking on risks. It then explores the measures of risk and return and the concept of the risk premium. The topic concludes with a look at the factors influencing the risk premium and the required rate of return for an asset. At the end of this topic, you should be able to describe an investment, identify the characteristics of the rational investor, define a return on investment, calculate single and multi-period returns, explain the different types of risk of an investment portfolio, elucidate the concept of risk premium, and summarize the factors influencing the required rate of return.
1. What is an investment? 2. The rational investor. 3. Measures of return. 3.1 Definition of returns. 3.2 Types of return measurements. Historical return, single period versus multiple period returns, annualized compound return. 3.3 Real versus nominal returns. 3.4 Translation gains or losses from international investments. 3.5 Tax implications on returns. 4. Measures of risk. 4.1 Definition of risk. 4.2 Portfolio risks. 4.3 Risk-free rate. 5. Relationship between risk and return. 5.1 The risk premium. 5.2 Investment decisions. 6. Factors influencing the required rate of return. 6.1 Factors influencing the risk premium of an asset. What is an investment? An investment is the commitment of money or capital, usually over the long term, to buy financial or real assets in order to obtain profitable returns in the form of capital appreciation of those assets or current interest and dividend income. An investment involves the deferring of current consumption for future benefits. With the exception of investing in a risk-free investment of short-term government treasury bills, all other investments come with some form of risks. The level of the risks should be commensurate with the potential returns of an investment, although in some cases, that is not the case. In contrast, gambling or speculation involves putting money into a short-term scheme in the hope of securing a financial gain. Gambling is the wagering of money or staking of something of material value on an event with an uncertain outcome, with the primary intent of winning additional money and/or material goods. Speculation is the practice of engaging in risky financial transactions in the short and medium term to obtain a profit from the fluctuation in the market value of that asset. The rationale investors. It is important for us to assume that the investor is rational, as it will be the base assumption for the portfolio management theory that we will discuss in this study guide. Characteristics of a rational investor. Risk-averse. If two investments have the same expected return, the rational investor will always choose the less risky alternative. Completeness. The rational investor is assumed to use all available information in a rational and coherent manner to arrive at his investment decision. Asset preference. The rational investor is free to incorporate any and all securities into his portfolio. Given that all investments carry risks, the rational investor is willing to invest for a specific return at a specific level of risk. The risk-return boundary marks the maximum risk that he is willing to accept for a given level of returns. The area above the risk-return boundary line represents acceptable investments, as the return is higher than the minimum required returns for each level of risk. The area below the boundary line represents unacceptable investments because these investments yield lower than the required return for that level of risk. What is return? Returns is defined as the gain or loss incurred by the investment in any accounting period. The returns would include the capital gain or losses, the change in the asset over this accounting period, plus any income derived through interest or dividends. It is usually expressed as a percentage of the initial investment. Return calculation can be for a single asset, equity, bond, building, etc., or for a portfolio of assets and securities. The calculation for both is similar, as the portfolio is merely the aggregate of the single assets. Historical return is just the measure of the returns of an asset or index in a particular period in the past. For example, let us use the data on ABC Berhad to calculate the returns of the shares for 20/2. The benefits of using historical returns are: 1. They are useful, as it might help with the forecasting of how the asset will perform in the future. 2. Provide the investor an idea of how the asset will react if faced with the same circumstances. Singles versus multiple period returns. We can easily calculate the returns based on a holding period of more than one accounting period. Let us assume that we want to calculate the returns for a 2-year holding period, 1st of January 20/1 to 31st of December 20/2 for ABC Berhad. We will just use the start price and end price of the stock, plus all the dividends received, to determine total return. Then divide the total return with the start price. Annualized compound return. In our previous example, we have calculated that ABC Berhad yielded an investor a total of 41.01% returns over 2 calendar years of 20/1 and 20/2. But what is the annual compounded return of the investment, which is used to compare investments over different time horizons? Essentially, one is trying to find out the geometric mean in which the investment is compounding over the investment period. Real return versus nominal return. Nominal returns are the returns generated by an investment before taking into consideration the impact of inflation. Thinking only in nominal terms leads to money illusion, as it can cause the investor to assume that the purchasing power is always constant for each ringgit earned. That is only true if inflation is non-existent. For the loss of purchasing power in the course of the accounting period, and reflect the true return to the investor. Real returns take into account the impact of inflation on the returns. They account for the loss of purchasing power in the course of the accounting period and reflect the true return to the investor. Another way to look at this is that the investment return contains the return generated by the invested asset and some gain in the overall price level caused by inflation. When the impact of inflation is stripped out, the true contribution of the asset can be ascertained. Most return calculations are prepared in local currency terms, which are in the currency of the listed asset or security. In our example of ABC Berhad, the returns are calculated as returns in Ringgit Malaysia. So the returns for 20/2 would be 23.27% in Ringgit Malaysia terms. These days, where international investments are common, there is a need to account for any changes in the exchange rate of the home base of the investor and the invested currency of the asset or security. Any movement in the exchange rate would have an impact on the net return of the overseas investor. The total returns to the USD-based investor in 20/2 will be the local currency returns any gains plus or losses from investing in Ringgit Malaysia relative to the dollar. The Ringgit Malaysia appreciated by 5.079% against the dollar in 20/2, so the dollar investor would gain because in dollar terms, the investment is worth more. Malaysia has no capital gains tax, but in other countries, capital gains taxes detract from the returns if the gains are realized within an accounting period. Within the tax structure, capital gains are split into long-term capital gain and short-term capital gains. The classification of the capital gains is dependent on the holding period of the asset in question and the individual tax code of the investor's home country. For the fund manager, the aim is to maximize the after-tax return to the investor, so the impact of taxes cannot be overemphasized. The fund manager must understand the tax situation of the investor and make provisions within the portfolio to minimize the tax impact, be it by purchasing tax-exempt securities or ensuring the portfolio has a favorable tax treatment. Measure of risk. Risk is defined as the chance that the outcome of an investment is significantly different from what was expected at the onset of the investment. This outcome can range from an entire loss of the initial investment to lesser gains than was expected. Risks are not confined to negative outcomes, as positive surprises pose issues of whether hidden leverage was employed rather than superior security selection. Portfolio risk. Many investors do not hold assets in isolation, but aggregate individual assets and securities into portfolios. The risk to a portfolio is similar to that of an individual asset, that is, the risk that the investment outcome is significantly different from the expected outcome. Portfolios do have the benefits of diversification, but not all risks can be diversified away. Common measures of portfolio risks. What is risk-free rate? The risk-free rate is the rate of return that an investor will obtain for investing in a riskless asset, i.e., there is absolutely no chance of any loss of capital in that investment. Thus, the rational investor will reject any investments that yield below the risk-free rate because he is better off investing in the risk-free asset. The accepted proxy for the risk-free rate is the domestically held short-term, 3-month, government treasury bills. There is no risk to the treasury bills given that the liabilities of the government will be discharged by the payment of the local currency, which is also controlled by the government. Note these must be domestically held government treasury bills, as foreign held assets usually require compensation for potential currency losses. The risk-free rate is an essential component of the modern portfolio theory, which will be discussed further in Topic 5, and this concept should be clearly understood as other applications build upon it. The risk-free rate is also an important input into a variety of formulas like the Black-Scholes option pricing model and the calculation of the Sharpe ratio. Earlier in this topic, we had examined the concept of a risk and return relationship, where a rational investor will only invest in an asset if the potential returns commensurate with the risks. The diagram shows some of the asset classes and where they are located on the risk-return spectrum. At the base of the spectrum is the risk-free, or riskless, asset, which will yield you the risk-free rate, given as RF. This is the minimum return that the investor will receive, and he will not accept anything below this quantum of return, as he would be better off investing in the riskless asset. The other assets in the investment universe will be distributed across the spectrum, depending on how risky they are, and the potential returns that they provide the investor. Towards the lower end of the spectrum, you will find assets that are relatively less risky, like bonds, debentures, and other fixed income instruments. For fixed income instruments, the riskiness of the asset will be determined by the following factors. The risk premium is the amount by which the expected return of a risky asset will exceed the risk-free, RF, interest rate. In other words, the risk premium is the amount of compensation received by the investor to forego keeping his money in the risk-free asset and instead invest in a risky asset. The measurement of the risk premium for a security or asset class can only be done ex post, i.e., seeing how much higher returns the security or asset class in question provide the investor relative to the interest received from the risk-free asset. Ex post measure is hardly useful for investment decision-making, so most investors rely on historical returns of the security or the asset class as an ex ante basis for investment decisions. Note the important caveats of using historical returns to project future returns previously discussed in this topic. The investor must be aware of these limitations. In the equity market, the excess return provided by this class of asset is classified as equity risk premium. This is calculated as the capital appreciation of the share plus any dividends received minus the returns of the risk-free asset. You will realize from the calculations that the risk premium had changed slightly from 20 by 1 to 20 by 2. If you had used the calculated risk premium for 20/1 as an input into your decision making for 20/2, you will be off by about 7.5%. Risk premium for a particular share generally does not stay the same every year, and in some equity down years the premium will be negative. Most investors use an average of the risk premium for a security or asset class. The average for the equity asset class itself over long periods is somewhere between 4% and 8%. That is the generally accepted range for equity risk premium. For fixed income, the risk premium is most often associated with the credit spread or the excess yield gained from investing in a bond relative to the risk-free asset. Equating the credit spread with the risk premium is theoretically not accurate, as it does not take into account of the fact that there is a chance of a default and that the return of a bond includes both capital appreciation and interest income. The risk premium for other asset classes would also be different to compensate for the risk inherently prevalent within the asset class. The important thing to bear in mind is that the amount of risk premium for each asset class will provide the basis of any asset allocation and individual investment decision. Investment decisions. The individual making the investment decisions will have to determine what the possible risk premium is for the individual securities as well as the asset classes that he will invest in. There is an inverse relationship between potential returns and the risk premium afforded by the market currently. If the investor ascertains that the risk premium is too low for an asset, he actually comes to the conclusion that the asset is overvalued on his metric. Conversely, if he finds that the risk premium is too high for an asset, for instance, due to exaggerated fear in the marketplace, then invariably he would find that the asset is cheap on his metric. The caveat is that although buying cheap assets and avoiding overvalued ones is the prudent course to pursue as an investor in the long term, in the short term this does not guarantee good performance, as cheap assets can get cheaper and there's no guarantee that the reversal of valuation will take place within the investor's time frame. The rational investor will only invest in risky assets if there is additional return to compensate him for taking that risk. This additional return is labeled the risk premium. The risk premium of different assets varies and is dependent on the level of risks the investment poses to the investor. The higher the risks, the higher the expected return or demanded return of the asset. This risk premium is influenced by the country where the asset is situated, the currency that it is traded in, the business segment that it is involved in, and whether the asset is easily liquidated without much market impact. The investor needs to be aware of the different types of risks that his investment asset and portfolio are subjected to. These include market risks, operational risks, and inflation risks. The investor should be aware of the risk measures that the fund manager uses to estimate risks, including value at risk, VAR, beta, Sharpe ratio, and standard deviation, as there are drawbacks to each, and these measures may understate the risks of the portfolio.